On Friday, the 7th of August, the U.S. Nonfarm Payrolls report delivered a genuine shock. Instead of adding jobs, the economy shed positions, a result that was far below even the most pessimistic forecasts. The bond market reacted instantly. The 10-year Treasury yield plunged to 4.64%, its lowest since early summer. This was not just a data miss, it was a fundamental rewrite of the economic script. Traders had to suddenly abandon any assumption of a tight labor market and price in a slowdown. To grasp the scale of the pivot, consider this: before the numbers hit, prime terminal data showed a 58% implied probability of a Federal Reserve rate rise. By the close, that figure had collapsed to just 30%. In other words, the market went from expecting tighter monetary policy to betting that the Fed's next move might actually be nothing at all. This matters because Treasury yields are the foundation of global borrowing costs. When the market sees weaker growth and no further rate hikes, it rushes into longer-dated bonds, pushing their prices up and yields down. That is precisely what we witnessed, and it is an enormous relief for mortgage holders and businesses alike. It was not only the jobs report, though. A parallel story in the Strait of Hormuz added rocket fuel to the bond rally. Hopes for a diplomatic breakthrough to reopen the waterway sent crude oil prices down 5%. Lower oil directly reduces headline inflation, which is the Fed's primary enemy. So, in tandem, the market got a signal of weaker demand from the NFP and a signal of lower price pressures from the Hormuz news. It is the classic double driver for falling yields. Investors are now pricing a world where growth is soft and inflation is retreating, without the central bank having to do the heavy lifting. This is, in effect, a free disinflationary impulse, and bond markets are celebrating it. Unsurprisingly, this seismic shift rippled through currency and commodity markets. Gold surged to nearly $4,300 per ounce, a 7-week high, because lower real yields make the non-yielding metal more attractive. The US dollar index extended its decline, as the appeal of holding dollars faded in the face of shrinking rate advantages. And the euro broke above its 100-day moving average against the dollar, a technical breakout that suggests currency traders are betting on a sustained US slowdown. For anyone with a mortgage, a business loan, or even a student loan, the rapid fall in Treasury yields is the most tangible signal that interest rates might finally have peaked. So, on this Sunday, the 9th of August, 2026, the market is breathing a collective sigh of relief. But what comes next? The Fed is now completely data-dependent. If the next inflation report shows further cooling, the 30% probability of a hike will slide towards zero. If the labor market weakens further, rate cut chatter will begin in earnest, dragging the 10-year yield toward 4% or below. The risk, of course, is that the Hormuz deal falls apart and oil spikes again. But for the moment, the dominant narrative is one of economic softening and fading inflation fears. The great tightening cycle appears to be on an extended pause, and that has profound implications for every asset class you own.